Okay. We're getting ready to review for Accounting 2071's final exam. What we do for this final exam is only cover chapters 12 and 13. This has been a request by teachers since I've begun doing these. So we're going to get started. If you have any questions on anything from anything earlier in the course, come see me after the review is over downstairs. I'll be happy to clear anything up you might have questions with. Okay? All right. So, first question. Mr. Pearl, account for margin note, has prepared the following product line income data. Gives us all this information. The following additional information is available, and they want us to prepare an analysis showing whether product C should be eliminated. Product C is showing net operating income of $3,700. So we need to determine whether we should keep it or not. This is a keep or drop decision. All right. So the way we start this is we start looking at our contribution margin. Our contribution margin is $10,000. Okay. All right. So we have lost contribution margin. Okay. This is negative because this is considered loss if we drop the product. All right. From there, we're going to read on and see what it tells us about the fixed expenses for the factory. The factory rent of $1,500 assigned to product C is avoidable if the product was dropped. So you can think of these as saved expenses. So rent, $1,500. I'm going to close this door real quick. Okay. The company's total depreciation would not be affected by dropping C. So we look at depreciation and it's still going to be incurred. So it would not go on as a saved expense. Eliminating product C will reduce the monthly utility bill from $1,500 to $800. So you would save how much on utilities? You would save $700 on utilities. Okay. All supervisor salaries are avoidable. So after utilities, it says supervisor salary. So the supervisor salary of $3,000 is also avoidable. If product C is discontinued, the maintenance department will be able to reduce monthly expenses from $3,000 to $2,000. So elimination of product C will make it possible to cut 2 persons from the administrative staff. Their combined salaries total $3,000. Yes, sir.
What about that 900 on the maintenance?
What 900 on the maintenance?
For product C.
Well, these are all costs that were allocated anyway. We're looking at the total.
Okay.
It said just for the company in total, they are saving from 3,000 to 2,000.
Okay.
That 900 was just how much was allocated to C when we have it in as a product line. Okay. So we just said administrative staff, and that's it. So we look at the total of the administrative or of the saved expenses, subtracted from your lost contribution margin, and the net result will tell you what happens when we drop product C. So we have 3, 6, 7,000 right here, 8,500, 9,200 in saved expenses, 10,000 that we lose. So that would be in total an $800 loss. Any questions? No?
They should drop it.
You say?
They should drop product C.
What happens if we drop product C?
We shouldn't. Or shouldn't.
Right, if we drop product C, we lose $800, so we should not drop product C.
Where did the 3,000 come from on the administrative expenses?
Star number 6. If you want to take a picture now. When I start the next question, I'm going to erase the board. All right, number 2. Part E43 is used in one of Rand Corporation's products. The company's accounting department reports the following costs of producing 12,000 units of the part that are needed every year. An outside supplier has offered to make the product part and sell it to the company for $14.70 each. Okay, so prepare a report that shows the effect on the company's total net operating income of buying part E43 rather than continuing to make it inside the company. All right. These are what we call make or buy decisions. Should we make the product ourselves or should we buy it from somebody else outside? Okay. So we're basically looking at the relevant costs or just the make a column for make and one for buy. All right. And the idea is you're basically going down your list. You're saying direct materials, well, if I buy 12,000, I wouldn't have to spend anything. But if I make it, then I have to spend 12,000 times 450, right? And that's if I make it, that would be 12,000 times 450 is 54,000. All right. Next one on the list is direct labor. Okay. Same way. If I buy it, I don't have to pay anybody to work. But if I make it, then I have to pay, wow, $1.20 per unit. Okay. Variable overhead, same way. Okay. Okay, I'm going to stop right there. All right. So, when I first stopped, I stopped at an outside supplier has offered to make the part and sell it to the company for $14.70. All right, now in the next sentence it says, if this offer is accepted, the supervisor's salary and all of the variable costs, including direct labor, can be avoided. So that's what I was just doing. The variable costs and direct labor, variable overhead, direct materials, direct labor, is this first. So it then says, the special equipment used to make the part was purchased many years ago and have no salvage value or other use. The allocated general overhead represents fixed costs of the entire company. If the outside supplier offer were accepted, only 5,000 of these allocated general overhead costs would be avoided. Okay? So, that means the depreciation of the special equipment will still continue, correct? Whether I make it or whether I buy it. In this case, whether I make it or whether I buy it, I'm going to still pay for it. It's the same amount. I don't even need to do any math. Okay? It says if the company's supplies, if the outside supplier's offer were accepted, only 5,000 of the allocated general overhead costs would be avoided. That means to make this product, the allocated general overhead costs the company 5,000. Okay? And then the final cost we're going to look at is the purchase price for 12,000 units at $14.70. Okay? Okay? And then you would look at the total costs. This is what those are. Okay. Any questions? What's up?
So if depreciation is zero, why did they put,
Depreciation, why do they put depreciation?
yeah,
as- Once again, you can do the math or you cannot do the math. It's up to you. So this is what we call the relevant cost. So this is the total relevant cost. What does relevant mean? Well, it's related to whether we make it or not. If I make this, I'm going to have to pay depreciation. But if I don't make it, I'm going to have to pay depreciation. I can put 230 times 12,000 and do that math and figure out what that is. Well, it is going to add some number. Give me a number, 50,000. I'm going to put 50,000 here, 50,000 here. Is it going to make a difference at the bottom line? If I'm going to incur the cost anyway, it's not relevant to the decision making. Okay?
that makes sense.
All right. So what happens, it says, question B, which alternative should the company choose? Should we make it or should we buy it? We should make it. If we buy it, we reduce our net income by how much? About 34,000. Okay. Any questions on that? All right. Number 3. Customer has asked Twiner Corporation to supply 5,000 units of product DO5 with some modifications for $420 each. The normal selling price of this product is $52.80. The normal unit product cost is computed as follows, and they want us to determine the effect on the company's total net operating income of accepting the special order. Okay? Direct labor is a variable cost. The special order would have no effect on the company's total fixed manufacturing overhead costs. The customer would like some modifications made to product that would increase the variable cost by $3.50. Okay? And that would require a one-time investment of $23,000 in special molds that would have no salvage value. This special order would have no effect on the company's other sales. The company has ample spare capacity for producing the special order. All right. Everybody have a picture of this if they needed to take it down? All right. So, determine the effect on the company's total net operating income of accepting the special order. So we're going to accept the special order. If we accept the special order, they want what? 5,000 units at $40.27 each, or $40.27 each. So we're going to look at the additional revenue we get. 5,000 times 40/20. Okay, and now we're going to look at each of the costs. Your direct materials. Direct labor. The variable overhead. Okay. And remember what it said? It said the special order would have no effect on the company's total fixed manufacturing overhead costs. that means you do not include the fixed manufacturing overhead, because the fixed manufacturing overhead is not going to go up for these additional units. Okay? But it told us that we would require modifications. And a one-time purchase of some special molds. Okay. Okay, so that's 5,000 times all of the prices. 1270, 610, 870, and the 350. Okay. Okay. And that total cost, when you add them all up, $178,000. So the incremental net income would be something like 23,000. Okay. Any questions?
On the variable overhead, is that 5,000 times 8.9?
8.7. Whatever you see right here. Desmond. Right here. You can just see right on the paper. You just take it straight off these, straight off the board. All right. Whoa. Anybody want to try number 4? Anybody? Anybody want to think about, want to walk us through how to do number 4? Harvey makes 3 products in a single facility. The mixing machines are potentially the constraint in the production facility. A total of 6,300 minutes are available for these machines. Direct labor is a variable cost in this company. Required. Which product should Hovey, I don't know, Hovey, attempt to fill demand for first, next, and last? Who knows what to do? Who has a question on what to do? So nobody knows what to do and nobody has a question on what to do. This is the weirdest thing that you can... What could we say about that right now?
How do you do it?
Great question. Okay. So, we get into this class, the first thing we learn is something about a contribution margin, correct? What does contribution margin tell us? Everybody have this picture taken if they need it, if they want it? Anybody, what does contribution margin tell us? Who can tell me what contribution margin is? It's sales minus variable expenses. And what does contribution margin tell us? What does the contribution margin per unit tell us? How much I make from selling it. Incorrect.
How much you have before you take out the
How much I have to cover my fixed expenses. Okay, how much each unit gives me to cover my fixed expenses, because I know my variable expenses are covered. So the first thing we do here is come up with that. What is my contribution margin per unit? Okay, who can tell me what my contribution margin per unit will be for A, B, and C? Because I know I have a sales price, right? And I need to start this probably a little bit higher up. That's how much. And I will take out so I have products A, products B, and product C, right? And I probably don't even have to do it that far away, but hey, we've got room. Product A sells for $70. Product B, $92.40. Product C, $85.90. Okay, these 4 marks are the 4 things we're going to have to take out from sales to get a contribution margin. What are those 4 things at a minimum? Direct materials, direct labor, fixed, variable manufacturing overhead. Thank you. Key words, variable. Everybody knows that MOH is manufacturing overhead, correct? Okay. And variable selling costs, correct? These are all our variable costs. You take away those things that vary with the product, we get a contribution margin. Variable selling. Okay. Who can give me the contribution margin per unit for each of these units? You know what this is? You good? Anybody got the contribution margin for product A for me? For product A? Contribution margin is what? 20. $30, $50, $35, 20 what? What? 70 minus 50 something? 70 minus 50 something would be 1160. Close job though. You forgot to take away from the 7 when you. All right. Who's got it for B? Isn't this ABCs? 10 minus 7, some easy numbers. $15? Good job. These are this is the hardest part of this, is making sure you get these small calculations correct. Okay? Product C. Because do they make you all use only the 4 function calculators? Man, that's tough. I had to go through it too, so I just use pen and paper. We can do 4 functions, pretty much I can do it. 1160? Dude. Punching time and the time you write down is the same thing. It's just how well have you memorized your multiplication tables. All right, contribution margin per unit. So is that all we need to know? No. What's wrong? What's happening here? You multiply it by the mixing per unit. What does multiplying it by the mixing per unit tell me? How does multiplying it by the mixing per unit give me the contribution margin per unit? I mean, because we want, you want contribution margin, because we want the contribution margin per minute is what you're telling me, correct? We want the contribution margin per minute, right? Anybody had to take like a chemistry class in this college career at any point in time? No, we're all business students, right? So we're lucky. Listen, we had to learn this if you were there. So right here we have contribution margin per unit. Okay? And then we also have mixing minute per unit. If I multiplied these, I would not come out with a contribution margin per mixing minute, which is what I want. Instead, I have to divide them. So here, I go ahead and say contribution margin per minute divided by mixing minutes per unit. Okay. And that will be 120, 80, and 40. And then what that will give me, if anybody cares, it's just what he said. Contribution margin per mixing minute when I divide. Make sure it's division. Okay. Wait. So, let us now rank it in order. Well, after we get our contribution margin per minute, what's our contribution margin per minute for A? 9.67. For B? 18.75. $29. Okay. Now, if you'd have ended up multiplying, your numbers would have been exact opposites, pretty much. Okay? So make sure you're doing division here. You say contribution margin per mixing minute. That's my constraint. Or per minute, per mixing minute, won't make a difference. We're talking about the minutes that we have available for our mixing machine. Okay? Now we're going to rank it in order, right? So that's 1, that's 2, that's 3, right? So we're going to say produce C, B, and A. I'm not sure if they're going to ask you this, but they gave this to me to make sure I reviewed with you. How much of each unit will we be producing? This is what we call the optimal production. How much of each unit should we be producing? How much time do we have to produce? 6,300 minutes, okay? So we're gonna start off with 6,300 minutes. What are we gonna produce first? Product C, how many are we gonna produce? 2,000, why? That's how much they demand, that's how much they want. Let's give it to them. We're gonna make $29 off of each one. So 29, 2,000, how much does it take us for each one? So I'm gonna make product C, 2,000 units times what? 0.4 minutes per unit, right? That's gonna cost how much time? 2,000 times 0.4, 800. Okay? Take away those 800 minutes, how much do I have left? 5,500. What's the next product I'm gonna make? B, 1875. So I'm gonna make B. How much demand do I wanna make for B? 4,000 if I can. So let's see, 4,000 times what? 0.8. 4,000 times 0.8.